diversify your portfolio and also want to trade in an asset class whose returns are independent to that of equity or debt market. So we have a chat box. I request to type me in the chat box. Yeah, I can see Vikram Bagri saying yes. Who all would like to diversify their portfolio and get into asset class whose returns are independent to that of equity and debt market? Yeah, thanks, Harsha. Bholenath, thank you. And how many of you want to know different data releases on commodities, understand them, interpret them, and become a better trader? Please type me in the chat box. Oh, great, awesome. I think chat box is buzzing. Arvind Bhatt says, I want. Aditya, Saurabh, thanks. Thank you all. So thanks. In case you're looking at answers for these questions, this is the right webinar. Before you start, may I also request you to just type in the chat box which city you hail from. I am from Mumbai, and we have Dan who's joined us from Coimbatore. Yeah, we have people from Calcutta, Coimbatore, Chandigarh, Nashik, Lucknow, Chennai, Bangalore, Alwar, Chennai, Bangalore. Wow, great. Thrissur, Kerala. Great. We have people across Noida. Awesome. So my name is Ramesh Varkhedkar. I head commodities and currencies business at ICICI Securities. Firstly, a big thank you for all of you for joining, taking off your time and joining us on this webinar on a Wednesday evening, 7:30 p.m. Right? We at ICICI Securities keep doing a lot of these webinars to educate our customers on currencies and commodities. And we do at least one program, and we keep calling experts from the markets. Like we have some previous webinars where we have done with the research person from Reuters. We have done with large corporate treasury heads. And today we have Gnanasekar with us. So a disclosure before I start, this program or this webinar is purely for educational purposes. It's not that I'm inducing somebody to trade, right? Because trading is something which will take a little time for people to understand. So we are trying to give some important informations like what all data releases and how to look at, especially crude oil and natural gas, which are the largest products which are traded on MCX. So with us today, we have Gnansekhar Thiagarajan, and I've been personally following Gnanasekar from 2010 onwards. Gnanasekar, it's been 13 years that I've been following you, right? And he is a veteran in commodity markets. He started his career in 1992 with Dalal Street Journal. How many of you have heard of Dalal Street? Yeah, you can raise hand or please type me. Even now, it's a very famous market magazine journal for capital markets. So he started with Dalal Street. He's passionate about currencies and commodities. Subsequently, from Dalal Street, he joined Dow Jones in 1996, which is the publisher of the Wall Street Journal. Heard about it? Yeah, I could get some responses in the chat. Great. And while working with Wall Street Journal, he worked with many of the senior traders across the globe in commodity trading. At Dow Jones, he also learned about commodities, and he also worked with big trading houses like Reliance Industries and ITC. So in 2001, Gnanasekar moved to Scotia Bank for the bullion desk. And I believe I was a banker in 2001, 2002 when I started my career. And it was only Scotia who used to do the bullion deals for many of the large bullion guys. So it was the only bank, big bank at that time. Now there are many who offer bullion. So in 2005, Gnanasekar started his own research firm, which is Commtrendz Research. And he's been helping a lot of corporates on currencies and commodities, helping them in risk management and hedging their exposure in currencies and commodities. He's a regular speaker on CNBC TV 18, Bloomberg, ET Now, Z Business, so on and so forth. And he's also pretty active on money control, giving research recommendations for commodities. So just type BIO, bring it on. So we have Gnanasekar. Gnanasekar, over to you.
Thanks, Ramesh. Thanks for this opportunity. I'm always happy to share knowledge with people who are eager to learn more. It's my what to say? It's my prarabdha. In Sanskrit, you call prarabdha. Is that's basically my dharma. So though we have a paid service, I would love to share whatever little knowledge that I have accumulated in these markets over the last couple of decades. Because it's a constant learning process. The learning process doesn't stop. Even after understanding markets for such a long time, markets have a way of teaching you every now and then. And, at every time you think you know something and you think that you know something compared to others, then markets have its own way of telling you that you only know a little bit, there's a lot to go. So learning process is something constant, which I think will continue. And Ramesh, I think you guys are doing a wonderful job. Having a lot of retail clients you're working with, and I've also followed many of your work and the webinars that you've been doing. And please keep up the good work. And all the best to your team. So today, I've made a broad presentation on the dynamics of crude oil markets, and some of the basics also I've covered to some extent, because people don't understand. They think it's crude is just crude oil future. It's not. There's a very deep, in-depth OTC market for crude oil and products. So if you can, come from there, you'll understand a lot. So basically, the presentation will cover some of these details, and what are the present dynamics and what is the scenario ahead is what we will discuss. And some of the important, data that comes out in the crude oil markets every week. So I'll try to throw some light on how to interpret this data which comes, and how to form a strategy subsequently once you do an interpretation, and eventually how it lands into a trade. And even that, you need to have a proper risk management system in place, because this I've seen in retail trade very often. People not adhering to stop losses just because stop losses get triggered quite often. But it's very, very important to adhere to stops, because if you fail to not adhere to a stop loss properly, the loss that one accumulates by small stops, the loss will be so huge, it'll take a long time for you to recover. A smaller stop loss is easier to recover, but if you don't put one, it completely turns against your view. Then to recover that will take a long time, and I know many people who got irritated and have gone out of these markets. And crude oil is such a commodity. Let's first understand why crude oil, because crude oil is given the maximum weightage in the crude oil index. The commodity index overall. So any commodity index, if one follows, now the present one which many people follow is the Bloomberg Commodity Index. So in that, almost 50% weightage is given to crude oil. Only then are the other commodities. And that too, the way they do the weightage is very interesting, because it's about which commodity is used largely in the global market space. That is given maximum weightage. So after crude, can you guess which is the next commodity after crude in terms of weightage? Can anyone guess? No, you're muted, Ramesh. I can't hear it.
They are saying natural gas. Some say gold, Brent. Okay, these are the answers. Natural gas, gold. Natural gas, gold. Predominantly, it's natural gas, gold. What is that? We have a participant saying copper also.
No, it's coffee. So it's nothing of that. So it's basically coffee, because the way coffee is used across the world. So they look at which commodity is extensively used. After coffee, you have cotton, and then only gold, silver, copper, natural gas, and all that. So the index is constructed in such a way that it covers the maximum usage across the globe. So crude gets almost 50% weightage. And because of this, the reason why I'm talking about index is because the investors, when I say investors, I'm talking about predominantly speculators who build huge positions in crude oil markets, they decide how much to allocate for the next year based on this, the index formation. So at the end of, in fact, in the next month or so, you will get the Bloomberg Commodity Index valuation for the next year. So based on that, some amount of capital is allocated for certain commodities. So crude gets the maximum. That's my whole point. So let's quickly jump into my presentation.
Gnanasekar, there is also a few requests. A few people have been requesting for Hindi. I don't know how comfortable you are, but you can make it Hindi English mix.
I'll try my best. My Hindi is really bad, so I don't want someone to yell at me if I.
Okay, that's okay. That's fine. Yeah.
Yeah. But pura try karunga. Okay. Okay. So how many of you all know that, when the process of crude distillation takes place, there is at least 100 different products that come out. It's all we know is kerosene, diesel, then naphtha, and natural gas, and a few other products. But there are 100 different products, and it's a very, very deep market for all these 100 different products. The OTC side, I'm saying. So you have the same banks, the Goldman Sachs, the JP Morgans, all of them have a desk which actively quotes on the OTC market, which is the trades that happen there is much, much higher than what you see in NYMEX, where the WTI crude is traded, and then ICE where Brent is traded. So it's such a deep market for, and in fact, there are even spreads which are active between one crude and another. So even that market is very deep. So this is the process. When you boil crude or when you heat, then there are different temperatures. You get different products, and a whole lot of products. So if anyone is interested in that, I think you can go to Google and check on the process and what all different products comes. Then you have petrochemicals which come much later. So that is another which largely comes from naphtha. So once naphtha is removed, so that is the feedstock for most of the petrochemicals. So what typically happens in a corporate when they are managing price risk is they'll see which one is linked to the crude price most. So, you look at the correlation between naphtha and Brent, you look at the correlation between naphtha, WTI, and then from there, you try to identify which is correlated well. Just giving an example of how corporates use this effectively. So this is the process, and I think we all have seen the what we call petrol is what is called gasoline overseas. Then you have kerosene, the diesel oil, which is again nothing but the diesel. Then you also call it fuel oil, and then different products come at different stages. So as the heating decreases, the gas is stored, and then that becomes the LPG, the natural gas, and all that stuff. So it's a wonderful process. I've seen this. I've gone to a couple of refineries. You have to spend days there to understand the different products and how it is, effectively managed. So we'll probably cover that in a different session. So let's jump into the important drivers for the balance of 2023 and 2024 going forward. So the current dynamics are that OPEC continues to take a stand that they will be extending supply cuts because they also have an economy to run, and they don't like crude prices going below a certain level because that affects their budgets. So therefore, OPEC the thing is, OPEC as a body was very weak at some point in time. Look at a decade back. They used to, each one used to do things independently. Though Saudi Arabia give a call that we need to cut or we need to increase, most of them won't adhere. But now I think Saudi Arabia has taken the lead, and they're very strongly, in the front taking this very seriously. So now the OPEC cartel is basically following the leader, whatever Saudi Arabia says. And so that becomes the kind of a road to follow. So OPEC's narrative at this point in time is very clear. They also understand that if prices rise too much, that's going to affect demand. So they're comfortable with something like a $75 to $85 range. But anything below 75 is very dicey for them. Difficult for them to manage their budgets. Which is why, ahead of this OPEC decision, which is now being postponed, it was largely expected that they would further continue the cuts. They would not just, continue existing supply cuts, but they might even increase it. That was the expectation. But looks like the decision, to postpone that has resulted in some profit taking today. Otherwise, morning it was comfortably above $77, $76. Now it's back to $74. Plus, you also have the other factors that I've described. China's rebounding post-COVID, but it's still nowhere close to what it was pre-COVID. The demand from China, and of course, we all know Russian supplies are still missing, and time to time, whenever prices go down, I think Russia also begins to feel the heat because unlike other producing countries, Russia need to support an ongoing war. So that requires a lot of funds. So they're very, very much dependent on crude oil income. And therefore, anything below certain levels make them very nervous. And then they would lobby with OPEC and join together because, Russia is a part of non-OPEC cartel. So it'll be a very constructive exercise, and that's what has been going on. And stock of Iran coming back into the market and supplying has also now taken a hit because of the recent escalation in tensions in the Middle East. So there's a likelihood they will even put fresh sanctions on Iran. And the demand right now is again a big question. We've seen China is rebounding, Asian economies are demand is good, but Europe and US are going through tremendous recessionary trend that's negative for crude oil prices. And therefore, the demand has been very moderate. It's not been spectacular to lift prices up. And of course, the geopolitics, is very much in play. You have the sanctions on Russia and Iran, which might tighten supplies in the near term. So that is going to be positive for crude oil prices. But if one looks at the bearish drivers, clearly the number of bearish drivers outweigh bullish factors that was seen in the previous slide. Now, the supply cuts are clearly inadequate to arrest falling prices because it's only sort of cushions the downside because we see some kind of a momentum that happens $10 or so, and then again it fizzles out. So the supply cuts are primarily to ensure that we basically put a floor on any fall in prices. That's what the supply cuts are up to. And OPEC and non-OPEC together are effectively doing it. So I guess it will continue according to me. But the point is, it hasn't done much to reverse the trend because the overall trend for crude oil is still on the bearish side. And the bigger picture is hinting that there will be more downside to crude oil prices. If not for this war situation, it would have already gone down towards $50. But because of these escalating tensions, one first from Russia and Ukraine, and now the Gaza situation. Now the Middle East situation is not that bad simply because unless Iran directly participates in the war, now it's a proxy war. They're using rebels to do that. But if they directly participate, then the Hormuz Strait, the sea front where most of the Middle East oil passes through Iranian waters. So what they will do subsequently, we don't know. They might cut the supplies or they might stop ships from going. But still, the supplies will continue, but it would take a longer time logistically. In a different route they have to come. So that's the concern for the market. So already a tight market, and then you have problems from Iran that could escalate things. And like I said, supplies from Russia are increasing because they have to fund the war over and above just running an economy. So they're quite desperate and they're doing everything in their circumventing the legal sanctions. They're doing a lot of stuff. The other bearish factor, which I think would take a leading role going forward, even till the end of this decade, is the alternative energy, which is the EV demand that's eating into fossil fuel demand. Now, the passenger car vehicle demand alone has, roughly around 1 million barrels per day's demand is being pulled into or pulled away from fossil fuel. And I'll show that in my future slides. So that's a bearish factor which will continue to be there for quite some time. Though the markets focus on demand supply from time to time, it's essentially the overall negative for crude oil, which in my personal opinion is a big sword that's hanging on the crude oil market all the time. And please remember that it's not going to just end with passenger car. There's a lot of movement into even commercial trucks are slowly getting into EV, buses, even aircraft testing has happened. So it's a huge threat as far as the fossil fuel is concerned. And then you have recessionary threats in the US, high interest rate regime, which is constantly weakened demand. Hopefully, in 2024, we will see cuts in interest rates, which are expected. So that will sort of boost prices higher. The financial market uncertainties are also very high. Stock markets have performed so well despite all these negatives, and people have seen abnormal returns in stock markets, and because of that, lesser and lesser funds have been allocated in commodities. But the uncertainty there is very high because it's a highly leveraged market, and we're at a sort of a peak where interest rates could peak out. But I'm not an expert in equities, but I think the uncertainty stemming from other asset classes are going to affect crude prices. Because when you say crude prices, it's also directly equated to demand. So that's the reason. The other key factor is the China demand, which is picking up for sure, but it is nowhere close to what it was pre-COVID. So numbers that have been coming so far has been showing a positive increase compared to the previous month and the previous quarter. But if you compare it with the pre-2020, they're all very, very negative. So a long way to go as far as China is concerned. The good thing is that they're continuously cutting rates to prop up demand. They're doing a lot of things from China, monetary stimulus and all that stuff. So that apart, you also have elections in the US which is coming next year, and the US government for sure will ensure that prices won't rise abnormally, and that's going to affect their re-election prospects. If gasoline is higher, then that will play in the minds of people. So that is one thing. So what they will do is they will talk to OPEC and then they will lobby with them to stop the cuts and possibly increase, and then they'll put more sanctions and on Russia, Iran, and all that. Or probably remove some of the sanctions or quietly allow supplies to happen. So all this is possible. So the bearish drivers are clearly outweighing the bullish drivers for going forward. So this is the slide I wanted to show on the EV. So how much of demand has gone so far is roughly, or till if you look at 2025, so another year or so, it will be in this range, 1.1 million barrels purely from the passenger segment, and then you have the commercial segment. So all put together, you'll have a huge loss as far as crude oil demand is concerned because it's moving into the EV space. And the latest numbers are that the EV sales have gone down a little bit. So markets feel that this is positive for crude, but it's not so, because if it basically signifies weak demand. If EV sales itself has gone down, fossil fuel sales, the movement into the other engines, that's going to take a longer time. So the point is, it's very important driver, a negative driver for crude oil prices, which will continue, I think, for the next 5 to 10 years at least. And then we'll see how things shape up. But for now, it's clearly a huge negative driver. The other thing is the OPEC decision. Now, I just, when I was doing this slide is when the news came that it's been postponed. But essentially, what markets are expecting is producers to cut more and prop up prices because, like I said, they're uncomfortable below $75. So crude demand rising is something which the forecasters, especially the IEA and OPEC, have been clearly citing that demand growth has been good, quite strong. But having said that, they also have concerns because of the way these interest rates have been at a peak, and that in turn affecting overall demand and also the alternative energy space. So all put together, at this point in time, because of the tightness in supplies, there is some amount of support for prices, and they're estimating China, the way it's rebounding post-COVID, to enter into a much stronger phase. So that's the main argument which both have. So Asian market is the key now as far as crude oil demand is concerned. So if you look at these numbers, I've shared the PPT with Ramesh. You can go through these numbers specifically. After Javi, more details chahiye, please.
Sure. The moment this webinar is over, this PPT and this recording would be there on YouTube. Okay. So people will be able to refer anytime.
Great. So if you look at the crude oil imports, they have clearly risen a lot in the last 10 months. But will this trend continue is a big doubt, because in the last year, countries like Asia, India and China have built reserves just in case there is a war-like situation, what will happen. So reserves have been built. But if things are normal in the geopolitical side going forward, then that reserve building will come down, and the demand will further decrease, and the reliance will be purely on retail demand. Just stop me if there is this data which is coming in, Ramesh. So that.
Okay, that's at 9 o'clock because of the US daylight saving.
Yeah. Okay. So
we have time.
So, okay, this is the important thing that we need to understand. Now, I have this slide here which shows you the inventory situation or the crude oil stocks of the US markets. And presently, if you look at these numbers, then we're talking about an increase which we are seeing continuously in the inventories, which means why the inventories are increasing is because it is not being used to produce more products, because the demand for products, which is basically gasoline, diesel and other products, are very low at this point in time. So once the summer demand gets over, the driving season demand, you have two important seasons firstly you have to understand in US, which is the driving season demand And the holiday, in fact, this Thanksgiving demand is also very big. For Thanksgiving, most people travel from East Coast to West Coast. The US is such a huge country. So it takes quite a long time to reach from East Coast to West Coast. And there's a lot of driving that takes place during this season. So this driving season demand is also going to be strong. But, refineries do the build up of these products much ahead. They won't wait till the last minute. So far, they've already prepared for it. Therefore, there is no increase in demand. But next week, the figures could be positive, is what my sense is. But this week, we will again see less of inventory. The inventory buildup will be more. And the last one was a huge one. If you look at the crude stock change last time, this is the expectation is 3.5 million barrels is what they're expecting, that it'll be a build. But the previous month was 13.87. It's a record sort of an increase that was seen. So that's a huge negative as far as crude oil prices is concerned, which is the reason why from $85 it quickly fell down back to the $75 zone. There's a huge supplies that are increasing in crude oil and the demand is just going down. So when you get this data, you have to look at the previous number and what is the actual number that was given in the previous week and what is the consensus for the coming week. So there's also a forecast and estimate that comes. So there's a consensus there will be a 1.79 million barrels of crude that will further add to the stocks. That's the expectation. So in case this number comes, let's say, lower or higher, based on that, you'll see volatility both the sides. So this number is very, very important to understand and, keep in mind. But also, keep in mind that markets exactly don't behave after certain data is released, because prior to the data itself, the market has discounted most of this information. So many times you'll see that it will be like a buy and rumor, sell and news concept, where markets have already seen the forecast, and if it is in line with the forecast, the markets will just ignore. And similarly, when you have a narrative like a tight supply situation, all this data will be ignored, even if it is negative. But if it's mildly positive, it will be taken with the trend. So that's the importance of this data. So you need to see what the underlying trend is, and you see right now the underlying trend is weakness in crude oil prices. So any negative data, so higher build which you see compared to the previous week, will only continue to pressure crude oil prices lower. So that's why this data is extremely important. So if you look at the recent trend there, the inventories. If the chart is visible, you can see the blue and orange highlights. The orange ones are indicating that the inventories are on the decline, and the blue ones are indicating that the inventories are on the rise. So if you correlate it with the price, you will see very clearly, somewhere around October or from almost January to September, there has been a continuous decline in inventory. So when this decline happens, the market also starts pricing that US there's SPR inventory, that they would come and replenish the stocks because this inventory is always built up so that there is no problems in the future, and there's no short supply of crude oil, which is why this inventory is being built up by the sovereign country, which is US in this case, and it's more transparent in terms of data, which is why you get these releases. You won't get such releases from China. Even India doesn't give this data so easily. Many economies don't post this so transparently. It's only US. So with whatever available, I think you have to go with it. But the point is, you have to very closely follow this build and decrease in stocks. So that sort of sends the trend. and understand the underlying trend. What is the underlying trend, and whether this data is going to help this underlying trend more, or it's counter to this underlying trend. So you need to sort of understand this very well. Like I said, sanctions have not been so effective because Russia is finding different ways of supplying. Where there's something called a shadow fleet. They're using old tankers to move their crude. So there are many things China is doing to circumvent the sanctions, and the $60 barrel is not at all effective. Because the minute it goes there, I think OPEC will talk the market up because they're not comfortable with $60 at all. So in some way, I think US also knows that if you keep on adding to sanctions and putting a noose on supplies in Russia, that will create a huge problem as far as inflation is concerned. Let's not forget the US is fighting inflation by increasing rates so far. The last couple of years, they've only been increasing interest rates because of rising inflation. So it's a tight rope that they have to walk. That's basically what it is. You're constantly seeing more supplies, though Russian supplies technically looks like it's not there, but it's pretty much there in the market. So why I got this slide, though it is slightly old, is let's not forget what happened. It's an extremely volatile market, driven by funds and driven by their positions, and therefore you saw this negative price in crude, which is just there for a brief period, but then this is the reason why you need to adhere to stop losses. You can literally wipe off all your profits and put you deep into losses that you cannot recover for the next decade also. So it's such a volatile commodity, and therefore, I think I really appreciate Ramesh and the way they've sort of focused more on options, because at least there the chances of you losing heavily is very much not there if you simply go with plain vanilla puts and calls. That's really good. I'm happy to see retail traders moving more into options, because that gives you that scope to manage price risk. So looking at the charts, I think what we're going to see is possibly an upside from here, a pure technical correction which is expected, which can take it up to around 80s, early 80s. That's how it looks. But then if it, let's say, breaks the recent lows, then I won't be surprised if it comes back to the July lows of 65 or thereabouts. But the situation is not that bad, is what my feeling is, because you are at the end of an interest rate cycle, and if that is confirmed by Fed on the December 12th, 13th meeting, then crude could really get some leg up at the end of the year. Let's also not forget to have a winter season demand that is coming. It's a very important seasonal demand for crude, which is the driving season, winter season. So that should all be extremely useful. So our broad view is that from here I see the downside being limited, and the chances of it to pull back higher to 80s is much more bright. So this is again very important. The CFTC data which comes, which gives you how much of speculative positions are there in crude from time to time. I don't know how many of you all track this data closely, but it's very important because speculators are when I say speculators, they're categorized as non-commercials in the US, because when you do a trade, you're supposed to disclose it either as a speculative trade or a commercial trade. If it's a commercial trade, you need to show that you have that much of inventories against which you're selling or buying. So every trade is clearly disclosed, and at the end of the week, you'll get this data, how much of speculative positions are there, open, and how much is there, which is not, or how much is there in the commercial side. So largely, markets track the speculative positions because they drive prices to a great extent. They provide a lot of liquidity and they drive prices. So if you see the way it has peaked is somewhere around 2019, where the positions were very, very high. And then recently, after this Russian war situation, we again saw a huge buildup, and that's decreasing quite a bit now. They're slowly cutting out their long positions, and they're thinning their longs. And also you also have a year end coming. Their calendar is January to December. So by this time, normally they sort of adjust their positions. And since they're predominantly on the long side, they must be adjusting positions now. That's what we're seeing. Week after week, the speculative positions are going down. So this data also comes every Thursday. I think this week it'll be delayed because of the Thanksgiving holiday. But the increase in speculative positions will, again, it increases abnormally. Then one needs to be aware that such a huge buildup in speculative positions will result in profit taking. Similarly, when it's the positions are very sharply down, then there is some scope for it to increase if there is some positive triggers that come into the market. So the CFTC positions have to be looked in again in terms of the trend. What is the current underlying trend? So to sort of conclude broadly, I think the WTI prices, which is the benchmark, is more or less in balance. I think both the factors are equal. In fact, there are more bearish factors. So whatever upside you might see based on the OPEC supply cuts or any other factor, positive factor, will be short-lived. Crossing $85 will be very, very tough for this commodity. And even if it does, it'll be for a short while, and it'll be short-lived, and prices will come back down again. So my short-term view is that yes, it might pull back because of the current tight supply, winter season demand coming up, and various other positive factors I highlighted. But in the medium term, I'm still bearish. When I say medium term, I'm talking about probably a year ahead or even more than that. So the longer term is very bearish for crude, but short-term uncertainties can lift it up. Basically the Fed decision and the financial markets, China demand, winter demand. So all that could have some kind of a near-term positive impact. So I'll quickly look at the option chain and the option strategies. My favorite option strategy right now is to take an out-of-the-money call option. Presently, I think prices are hovering around 6,200 or thereabouts. So if you take an out-of-the-money call at, let's say, 6,500, that's like a deep out of the money. But then you save quite a bit of premium there. That will be a good strategy for the short term. So buying calls, plain vanilla calls. And so you can come up with various other strategies also, which I think Ramesh and this team is extremely good at. But a very plain strategy right now would be to accumulate more calls and out of the money calls. So I'll also quickly take you through. Do I have another 10 minutes, Ramesh?
Sure. Yeah. I think we are already at natural gas.
I'll quickly touch upon natural gas and then we'll be done with that.
Sure. We have some questions which we'll take at the end. I've just made a note of all those questions. Okay. So we'll try to cover as many as possible.
So just tell me if you overshot or something, because I have a feeling I overshot the time.
Sure. I think you can take another 2-3 minutes and cover the natural gas.
So natural gas, it contains quite a bit of compounds. Again, the process is this. You have oil and gas, which is sort of stored, and then it goes through a processing plant where it's also compressed. So that's why it's called compressed gas. And eventually it gets into LNG storage for transport outside. So you can, send natural gas through pipelines, but within the country. But out of the country, if you have to export, then you have to compress it, which is liquefied natural gas, and then you export it out. So this is the process of natural gas. if you're interested, you can Google and check all this. But broadly, this is the process. It's important to understand all these basics, because without this, it will just be another commodity, half interested thing, which you'll be trading on. So the major supply side factors that affect is the amount of natural gas production and the level of gas and storage. These are the two important supply-driven factors, actually. And the volume of natural gas imports or exports that happens. So whenever you see exports happening, which means the economies are doing well, they're using a lot of natural gas, being a cheaper alternative to fossil fuel. It's used in industrial purposes in a big way. So what are the demand side factors? Basically, it's the winter and summer demand which affects natural gas prices. So it's highly weather driven. So you have to follow the weather developments very closely. Now that you have a winter season coming up, so it's very important to keep an eye on all those news headlines that are talking about weather. And then the level of economic growth, the Fed decision, all that will be a very, very important factor that will play on the demand side. And also compared to other fuels, what is the availability and price and discount and premium that it enjoys. So if one looks at the present sort of factors that are, So the present situation is that there's excess supply. There's a lot of storage of natural gas that's happening, and it's unable to cross above $3. That's a very tough resistance globally. It's not able to do that, and the storage report, which is due again today, is going to again show a build of 2 billion cubic feet. That's what they call as BFC. So further storage and lesser demand, that's going to result fundamentally in weakening prices, which is what we're seeing. Unable to sustain at $3, it's being sold off, and more increase in supplies, weakening demand. There's a clear recipe for a bearish market in the short term. Again, if you have to interpret this data which comes from different regions, especially in the US, you can compare the present build or decrease with the year ago average or 5 years average and see where it is. Is that too much or is it too less? How the market is going to interpret that? So you need to not only have the current figures, you need to have data 1 year ago, and you have that information on the internet. Again, these are all sourced from commonly available platforms like EIA, which releases this data from time to time, and also from the other sources, official sources. So keep these things in mind. Don't just look at the current build or the current decrease in the storage levels, but look at it in terms of what it was a year ago, what it was 5 years ago, and see where the percentage change. Is it increasing largely or is it decreasing largely? So right now, if you look at the longer term and the short term is increasing and the long term is just slightly on an increase. So the point is, it's hinting at more weakness actually. And this is a very important slide too. Again, on inventories, you can see the blue ones are the build in inventories, and the red ones are the down tick that you see in inventories. During March, April is where that happened, and that's the time when natural gas prices sort of got a upside flip from the recent lows of $1.70. It came up to $3 now. But if you link the price with the inventory situation, you'll get some wonderful strategies to work on. So the outlook for demand, as far as natural gas is concerned, is it's good as of now. And especially when there's escalation of geopolitical tensions happen, then suddenly the demand picks up, because there is a fear that we've seen that in the past. We have come from all the way from $10 to where it is right now, from the Russian situation, now the Middle East situation. So whenever this news flows on a war-like situation happens, then suddenly demand picks up. So the geopolitical situations results in good LNG exports. So that's one thing you need to keep an eye on. Looking ahead, I think clearly, you have a favorable outlook because you have weather that's going to be resulting in cold season for natural gas, and that's used a lot during cold season to run heaters and even for industrial purposes. This is the chart of natural gas prices. I took a longer chart just to show you how well this $1.50 to 60 cents have been defended quite well. And it came very close to that this year, somewhere close to 1.7. And it's bounced from there. But will this continue? My sense is with the way the economy can rebound in 2024 and the financial situation, looks like there is going to be a possible rebound in the first quarter of 2024. But subsequently, we need to see whether the China demand sustains, all the positive factors sustain. And also the CFTC positions, like how you saw in crude oil, even here it is very important. Only during 2021, funds were long in natural gas. Their long positions were very high. Otherwise, they've been always short. These red ones indicate that they're on the short side. So recently, the short positions have increased. If you can see the recent line downtick, it's indicating weaker economy and higher supplies. Near-term weakness is there as far as natural gas is concerned. So presently, I think prices are stuck in this broad range. But our own understanding, based on various negative factors, till at least the FOMC decision is announced, there is a good possibility it might come down to $2.45. I think in local prices, we can see it below 200 rupees in the domestic markets. But from there, it will see a very sharp rebound post that. So post this FOMC decision, I think one can clearly start positioning again using call options as prices go down. But in the near term, you can continue with puts and possibly increasing your positions in futures. So with that, I think I'll end the presentation, hand it over back to Ramesh. Let's take questions.
Thanks, Gnansekhar. Thanks for that presentation. And thanks for all those data that you showed, how to read that data, especially on the inventories and also those charts. Thank you so very much. While you were giving your presentation, there were a lot of questions which were coming up, and I have tried to answer on the chat box as many as possible. We had almost 200 plus participants when we started the session, so there were many questions. There are a few questions which I've just made a note. There was a question from Gnanasekar and says that there are practical issues, things to take care. So you talked about risk management, right? So Gnanasekar, I don't know he or she, but they want to understand what are the things that a retail investor should take care while trading into these commodities. In case you can just give an answer on that.
Yeah, it's a very interesting question because I've seen many people get hit very badly. They don't come back at all, thinking that this is a wildly volatile market because they're used to equity markets in India where an intraday trade going wrong becomes a long-term investment. So that doesn't happen in commodity markets, unfortunately. If you get it wrong, you have to accept that and then look forward to what to do next. When I was with the bank, stop losses is something which has been ingrained into our DNA. Because if I forgot to put a stop loss and if the audit catches it the next day, then I'll lose my job. It's as simple as that. So therefore, this process of stop losses, even though it hits and then it's irritating you, by constantly stops getting triggered, that might happen. And that's bound to happen going forward. But that should not stop you from not adhering to stop loss. Maybe you can increase your stop loss, but not putting a stop loss is a very, very dangerous thing. So, and then, the one more thing which retail investors I've seen time to time make this mistake is when they see their calls or calls or sorry.
Hey, go ahead. Yeah.
So when they see their calls on the market going right, then the leverage is increasing. Their confidence increases. The leverage also increases. The confidence increasing is fine, but do not increase the leverage, because that's where you'll end up wiping out your profits. So if you stick to a certain lot size, and you can gradually increase it, for the first 3 months, stick to the same lot size. The next quarter, you can increase the lot size, but have a standard lot size when you make your winning trades as well as losing trades, because that is what will give you a net P&L, positive P&L at the end of the year.
Sure. So there's another question from Hari Vijay, which I'll take. What is the time of crude and natural gas storage data? So yeah, you covered about it, but just to share, see, commodity markets run 9 o'clock to 11:30, March to November, right? And from November to March, first Monday of November to March, second Monday, it runs up to 11:30. So whenever the markets run from 9 o'clock to 11:30, the data comes on Thursday for crude oil at 8 o'clock. Whenever the daylight saving happens, it's at 9 o'clock. So for example, today, the data is going to come at 9 o'clock. Similarly, for natural gas, it's every Thursday, 8 o'clock. And whenever this markets get extended by another 25 minutes, the data comes at 9 o'clock. But tomorrow being a Thanksgiving Day and a US holiday, the natural gas data will also be released today around 10:30. Right, Gnanasekar? Yeah, it gets released around 10:30.
The crude oil data comes on Wednesdays.
Yeah.
And the CFTC data comes on Thursday. And the natural gas data is on Thursday.
On Thursdays, right. So there's another question, Harishankar Banerjee is asking, will the stop loss work even when our markets are closed? If not, what is the implication? So
yeah, see, there's a very good likelihood, markets will gap up or down by whatever percentage in the morning. If you have a GTC stop, a good till cancel stop, that might work, but I don't know if GTC stops are prevalent in MCX. But what it does is, at least on the next day, if you're having a GTC stop, whatever price it opens, the first trade, it takes priority. Wherever there's a GTC, it fills that first. So it's good to have a GTC stop as far as the retail investors are concerned, so that it sort of captures the overnight developments also.
Right. Just to elaborate, what is GTC, GTD? Because that concept is not there in equity. They do a VTC, valid till date. Here, GTC is good till cancelled. So till the contract expires, you can give that, and till you cancel the order, that will be valid. That's one. Another order is good till date. So in case the contract is expiring on 30th, and you want to put it till 20th, you can select 20th, and your order is valid till 20th EOD. So there are two concepts, which is GTC and GTD. Great. Moving ahead, what really causes fall and rise of prices? This is the question from Mr. Prabhakar. So
it's basically demand supply, various factors. I think I covered most of it in my slides.
Yes.
And more than demand supply, it's also the market psychology, because there is data which will come, but the market will go exactly against that data. So you also need to understand. That's the reason why I've seen this in banks, especially when just before the data, everyone will stop quoting, because no one knows what the data is going to be and how the market will interpret that data subsequently. So you need to give it some time till dust settles after the data is released, and see where the markets, how they're interpreting it. Is it in line with forecast? Is it against? So always when you're planning your trades ahead of any data, yes, you need to have enough stops in place. But then ideally, give it 5 to 10 minutes post data, and then you trade. Where the markets have digested this data, and I'm saying this purely from the retail perspective. Need not punt before the data has come, but you can do that with stop losses and options. But ideally doing post the data would be the best way to do it.
Yeah. There's another question from Amaya Kumar. He's saying he wants to understand on the stop loss. So, Mr. Amaya Kumar, for everybody's interest, I have put one link of YouTube, how to play stop loss. I suggest, in case anybody is interested, you can just click that link, save that link, and have a look at it. Right? That's awesome. I have shared a Telegram channel link on the group, and we keep sharing updates on Telegram. I request each one of you, whoever is interested, can subscribe to that, and you'll keep getting all those updates and research reports on Telegram on a daily basis. We keep sharing a morning report and there's an evening report. That's point number one. Second thing is, we have a research team. We keep coming out with research recommendations. So in case you are an ICICI customer, you can go to I click to gain, and then you have all those research recommendations which keep coming there. Few important points that I wanted to highlight. In energy products, there's a pre-expiry margin. So apart from that initial margin that you give before the expiry of your futures contract, 5 working days before, each day there's an extra margin of 5%. Right? So one needs to look into the ROI, because already the margins for natural gas is close to 30%, crude oil is 40%. With this 5 days of margin, and in case you hold till the end, the margin requirement would be 65%. So you need to look into ROI and then hop on to the next month's contract as and when the pre-expiry margin kicks in. Many customers come and they say the position has been squared off. It's because of everyday 5% pre-expiry margin, which keeps increasing for last 5 working days. So that's one important point that I wanted to highlight. So one can trade through Super App, Markets App, and Web. It's all available there. I know it's 8:32. It's already 1 hour, 2 minutes. We thought of having this session for 45 minutes, but still I can see more than 120, 130 people on Zoom and another 13, 20 on YouTube. So 150 people are still there. Thanks for your patience. We try to cover as many questions as possible. But before we end, I'm just typing in chat few numbers of the advisors, right? And these are the numbers where people are available from morning 9 o'clock till 11:55 in the night. So in case you have any further questions, feel free to call them, reach them. They'll be able to help. They'll also be able to help you to place your orders. So I'm just typing those numbers here in the chat box. Yeah, so these are the numbers that you can reach. I know it's just a 1 hour webinar, not possible to sync everything, learn everything, understand. So this webinar will also be available on YouTube, and there are many other webinars also. If at all you do ICICIdirect commodities, my request is whenever you have time, please go there, have a look at those webinars, understand. Before you think of making money, learn all these things, understand, and then hop onto commodity markets. So these are the numbers that I'm typing in the chat box, where you can connect with the advisor and they'll be able to help. Right? So I've put those numbers: 4075-7350, 4075-7294. These are all Bombay numbers. And then the third one is 4075-7259. Yeah. So I know it's been more than an hour. Thank you so very much. Thank you, Gnanasekar, for taking off time. Right? It was just a message that you accepted it. Appreciate it. Thank you, all the participants. Hope this webinar has helped you, even though it adds another 1% more to your trading knowledge. And if at all you can be a little better trader than what you were yesterday, I think we have done our job. So thank you so very much. Thank you. Thanks all.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.